First of all, it's obviously a very impulsive move. This is not a type of move that you see in a typical and normal retracement. This is something that looks more like something like the start of something to me. Even this move down in here was very much a retracement, a very clear three waves down. In this case, it's really harder to come up with three waves down in this to call this a retracement. So I think that's one thing that really stands out to me about this. Additionally, what's also very clear is the movements you're seeing with the way that this market is really flowing. It's very apparent especially when you look at the S&P 500 futures and you tie that into the Japanese yen. We're moving not just with equities. Equities are moving as a result of what's happening in currencies. You can clearly see that the Japanese yen has been strengthening now for some time, going back into the really middle of February and maybe even before that. And what we're seeing here is a lot more of the equity market moving with FX. And that's important, right? Because that's telling us something about the flows of money that are coming and leaving the U.S. markets and going to other places. Additionally, a lot of people have been pointing to some of the strength in taking place in places like Germany. First of all, the movements and the strengths in Germany are really nothing new. They've been kind of going on now for the same amount of time that they've been going on here in the U.S. And I think a lot of people are just assuming that, as soon as, things sort of normalize here, you're going to see that return to the historical norms in these relationships. But clearly, there have been times where the two have detached rather meaningfully. Here's an example. In late 2014, 2015, obviously a very big surge in the DAX, not followed here by the S&P 500 at all. And in fact, the DAX ended up giving all those gains back. Again, very similar sort of move also took place here in 2016 into 2017. So I would say that the movements you're seeing in the DAX aren't necessarily indicative of something that should or shouldn't happen here in the U.S. The other piece that's obviously very important, you haven't really seen those same flows really carry through in the Nikkei. In fact, the Nikkei really hasn't done anything, I would say, since the spring of 2024, so call it almost a full year. And certainly the equity market here in the U.S. is really traded very similarly in a lot of different ways to what we've seen in the Nikkei. In fact, when you look at the S&P 500 and you look at it in Japanese yen terms, you can certainly make a case that there's a much stronger relationship between the two. And so you really have to question whether or not, how these money flows are working. And when you look at the DAX, also when you look at it from a euro standpoint, and you look at the S&P 500 from a euro standpoint, again, you can start making a case that perhaps some of the S&P 500 was kind of leading the DAX higher as opposed to the DAX leading the markets higher. So the other factor is you have to remember that, if you're a foreigner and you're, investing in the U.S. and you convert your euros into dollars to then go out and buy equities, depending on what the movement of the currency is, you may not really be feeling the full benefits. And in some cases, depending on what the currency is doing, you could actually be losing money. And so that's why it's really important to be paying attention to these things and to really be thinking about them multidimensionally. And, when you look at something like the S&P 500 futures, again, and you put them into Japanese yen terms, what you kind of notice is something very important here. What you see is that you'll take the trend line here, and there's been a clear and very clear break of an uptrend. And no matter how you want to draw, whether you take it from this plot or you take it from this plot and you just, put it out, you can see that uptrend is broken. And I don't know if there's any significant meaning in that, but I think that means something. And what that means at this point, we're going to just have to wait and find out. But clearly, that violated a trend line that's been in place now since May or April of 2023. And remember, May, April of 23 is a very important time from an investment standpoint, because that's what gave rise to NVIDIA. That was when we really started to see the AI craze begin to move. And it's kind of funny how when you look at the S&P 500 in Japanese yen terms, and then you overlay it with the chart of NVIDIA, how the two look so similar to one another, and how perhaps a decline in NVIDIA may be symbolic of what's really happening beneath the hood with some of the flows that are taking place. The other piece, obviously, like I said, when you look at it in euro terms, you're seeing, depending upon, again, how you want to draw this out, it's kind of easy to say that this uptrend is broken. Whether you come all the way out to the lowest end of the wick or you decide to come in and try to make 1 or 2 more points click, the uptrend is obviously broken. And again, this goes back to and starts right at that low in October of 2023. And of course, you have to wonder, how much something like currency really plays into a lot of this. Well, I mean, clearly the euro wasn't doing much here, but you can obviously see that the last surge we got in the S&P 500 had a lot to do with the euro coming down, and it has to also corresponds with the euro strengthening now. And again, this could be indicative of what's happening beneath the surface with a lot of the money flows and what's really taking place in the markets. And it could very well be that the reason why you're seeing the equity market get hammered right now is because foreign investors are just had enough. They don't understand what's going on in this market. They don't know what Trump's going to do. They don't understand these trade policies. And they're looking at a U.S. market that's trading well over 20 times earnings and saying, why do I need to be invested here when there's potentially opportunities here at home? And maybe that money is going back home to these other locations. And that's certainly a possibility. I mean, certainly when you look at the Hong Kong Hang Seng Index, that's been doing quite well. And it's perhaps doing well at the detriment of what's happening here in the U.S. In fact, I always had a little bit of a theory that I had with some of my subscribers back in the old days of 2023, that some of the reason that you were seeing so much strength in the NASDAQ was because everyone was dumping Hong Kong tech and going into U.S. tech. Well, clearly now you can see money is flowing back into those Hong Kong names, and potentially what we're seeing again is a flow out of U.S. tech. Notice that the big rally we started to see in Hong Kong also kind of established and started around the same time you started to see the NASDAQ and the S&P 500 melt down in the summer months. And, again, I don't really know how much this is coincidence. And you have to keep in mind that the Hong Kong dollar is pegged to the U.S. dollar, so you're not really going to see much of the currency fluctuations. You're looking at a situation here where you're potentially just seeing, assets being sold in the U.S., dollars being converted into local currency, and local currency then being brought home. And again, last night I had mentioned this in the video, but again, one way you can kind of keep tabs on this too. I mean, not everyone's going to probably have access to stuff like this, but you can just simply look at a 5-year euro basis swap spread, and you can see that there's been a tremendous, easing of funding conditions for U.S. dollars, and obviously demand for euros has increased because the cost of financing dollars has gotten, cheaper. The spread has head towards zero. When you look at it from another perspective, again, when we look at it in terms of an interest rate, perspective, you can clearly make a case and say, well, going back home, selling my treasury, selling my dollars, bringing it back, repatriating my euro, and then putting them into the German 10-year, which is now yielding a much higher rate than it was previously. And at the end of the day, a lot of what's driving the euro strength is that the spread is changing between the German 10-year and the U.S. 10-year, and that's allowing the euro to strengthen. At the end of the day, that's all the currency is doing, and it's the same thing when you take the U.S. 10-year and you minus it from the Japanese 10-year. Again, the same relationship. So question really becomes, if it is, money flows that are deriving the direction of what's happening in the S&P 500, and those money flows are being determined by changes in interest rate differentials and monetary policy and really more fiscal policy, then it's quite possible that what we're seeing in the S&P 500 right now is the start of something a little bit more broad, that it's the start of something that's bigger than just your typical 10% correction that you normally see. And I think it's worth considering the idea that this is not something that you can just assume that you're going to go back to the all-time highs again or make new highs. I'm not saying you can't, but what I'm saying is that if policy continues to go the direction which is going, which is that, you're going to have these tariffs put in the U.S., that you're going to potentially see slower growth, you're going to see the government shrink, and you're going to see less stimulus or less fiscal spending here in the U.S., and you're also going to potentially see a Fed that's going to be forced to have to really start cutting rates at some point down the road because of that slower growth. Meanwhile, at the same time, you have Europeans spending money to build up their defense and infrastructure and things of that nature. On top of that, you have Japan, where they're in the process of actually raising interest rates. And you have Hong Kong and China, which are spending as well, trying to get out of a recession. You have to think about how that money flow is going to start going. And you have to think that you're going to start seeing the unwind of a lot of the positioning and all the flows of dollars we've had into the U.S. over the last 18 to 24 months. And if that happens, it may mean that the declines that we've been seeing in the S&P really aren't just your typical correction, that this is, potentially, the start of something much more. And unfortunately, I think it's just going to take further time to really figure that out. It's not to say you can't get a sharp, 4 or 5% rebound in the equity market and it's going to feel like everything is great again. But it's also very possible that, there's something else changing here. And I think for that takes a little bit more time to play out. We also have earnings season, which is going to be coming in April. How are all these policies going to affect guidance and things like margin and forecast going forward? All going to play a heavy hand in what happens next. Anyway, I know this was a little bit different than we normally would have done, but I really wanted to touch on this because I think when I look around what's happening, on social media and all the different things I read, I think there's just too much of the assumption of everything being normal. And I think there's not enough being paid attention to what's happening actually on a global macro perspective. And I think that is really the key here, and not reading the technical charts and trying to figure out where you are in an Elliott wave count, which, by the way, can go back and change at any point on the line. So I used to play around with those as well at points. Anyway, have a great weekend, and we'll see you again soon. Bye.